So what is changing with whole life insurance when it comes to the 7702 update? A lot of things, some for better, some for worse. In this video, we are going to go through two topics when it comes to whole life insurance and questions we received around these two topics. The question that we received is, what will change? The first topic or subject I'd like to touch on is policy design, one of my favorite things. So when it comes to policy design, specifically with the major mutual carriers, there's been no change. Meaning, if I want a policy where I'd like to pay in any amount of money, often the lowest I can drive that base premium is about 10% of the total payment or total desired payment. So what I mean when I say that is this has been the case for a long time and still is the case. If you wanted the ability to pay in up to $100,000 per year, but you did not want to get a bill for $100,000 per year, you could literally commit to the premium piece only, the $10,000 per year. That could even be paid monthly. And then 100% at your discretion, you can pour excess funds into PUAs, hyper growing the cash value. The most aggressive we could go with those top companies is that 1090 split. There's been no change there. Nothing that we've seen. I've talked to companies about this a number of times, and that has remained the same, which is nice because I can still design a policy for minimum expenses, minimum compensation, maximum consumer value, which if someone's interested in that, that's how a policy should be designed in my opinion. What I will state is in respect to the 7702 change is often we receive questions around, hey, should I go with a 1090 split or should I go with a 3070 or a 6040, whatever it might be? And a 1090 always delivers the strongest guaranteed values, and based on actual history, real performance, it has always delivered the strongest net cash values. What we've seen in respect to how companies have repriced their products to comply with this new change, because some companies have made a number of adjustments, not just their guaranteed rates, we've seen that a 1090 design is even more favorable with this 7702 change than what it was before. And what I mean when I say more favorable is comparing it to policies that also comply with the new 7702 update, but with a higher base premium. So a lower base premium, if your goal is maximum cash value, that'll do the trick. But of course, we can always look at different options because it's always good to see options. The one thing that did change, one of the things that changed quite a bit, guaranteed rates. So since the 1980s, guaranteed rates with whole life insurance policies have been at 4% with most companies out there. That's gone. As of 2022, it'll be gone with all new contracts. If you have purchased a product with a 4% guarantee, or you make a purchase up until 2022, so during 2021, you can still lock in the guaranteed rate of 4% if that makes sense for you, if that's the best option. It's always good to compare and contrast because there are advantages to this. But that's been in force since the 1980s. Now, what I want to touch on next is something a bit technical, but it is important. The guaranteed rate on a whole life insurance product does impact the MEC limit. So we have here guaranteed rate of 3%, MEC limits increase by about 40%. Let's start with the 4% guarantee that has been around for a long time. If I take an age 40 male, and that 40-year-old says, hey, I want the ability to pay in up to $100,000 per year, we would need a MEC limit of what? $100,000. What has a direct relationship to the MEC limit on a life insurance policy? Because you can set the MEC limit wherever you'd like. The MEC limit has a direct relationship to an individual's age, that's why I specified 40 years old, their age, and also death benefit. So based on a 4% guarantee, the needed death benefit is that guy right there, $2.8 million. And because most companies have had a 4% guarantee, that's where we have seen all companies need to require about the same death benefit for the same MEC limit. Meaning a 40-year-old male with MassMutual, Guardian, New York Life, any company out there, if they have a 4% guarantee, I'm going to need about $2.8 million in death benefit in order to obtain that $100,000 MEC limit. Now, guaranteed rates are adjusting. Companies have the choice to set their guaranteed rate anywhere between 2 to 3.75%. Some companies have filed guaranteed rates of 3% across the board. So for example, New York Life and Guardian has filed a 3% guaranteed rate for all of their products. MassMutual has filed guaranteed rates between 2 and 3.75% depending on what whole life insurance product you select. So that's where having awareness, one around the actual guaranteed rate, but two around the MEC limit with a particular product and company is important, and it will not be an apples to apples comparison in all cases like it has been for a very long time, since I was born in the 80s. So if we isolate the guaranteed rate though, what I want to touch on here is how it impacts policy performance. Lower guaranteed rates will result in lower guaranteed values. So when I compare a whole life insurance policy on an individual, not a bank-owned life insurance policy like we've looked at in past videos, but an individual policy, the policy with the guaranteed rate of 4% did produce stronger guaranteed cash values and internal rates of return than what the 3% guarantee does, which makes sense. But here's really what I want to touch on, is if I have a company that has a 5.65% dividend, like Guardian for instance, that's their total dividend rate for 2021. If you were to Google search that, that's what would pop up. Now, it used to be a 4% guarantee, which means the surplus was 1.65%. Here's where I'm going with this. 3% guarantee means the declared surplus rate is now 2.65%. And why that's important is when you look at the dividend column on a life insurance illustration with any company, that annual dividend column does not, let me emphasize this point, does not include the guaranteed rates. Meaning that dividend column only reflects the surplus piece. Even though it says annual dividend, and I would think, hey, it's the company's dividend rate, I wish it was like that, but it's not for a number of reasons. So let's take a look at an illustration here side by side so we can actually see the comparison. Before we do that, what you will find is the MEC limits, because the guaranteed rates have dropped. If I have a 3% guarantee, I get about a 40% increase. So, for example, with the 3% guarantee for the same age 40 male, so same scenario here, same $100,000 MEC limit, we're going to assume that's exactly the same. The death benefit I need is not $2.8 million with a 3% guarantee. If I go with a $2.8 million death benefit, I'd actually have a $140,000 MEC limit. So the death benefit needed for the individual that says, hey, the death benefit right now I don't care about, I want maximum cash value, we would need a death benefit just north of $2 million. That gives a 40-year-old male a $100,000 MEC limit based on a 3% guarantee. If that doesn't make sense, please comment in the comment section below. So overall, weaker guarantees, but you will see greater long-term potential. Companies have been able to kick down their insurance expenses, their reserve requirements. Because of this change, it has helped them, and they are trying to give that back to the consumer as well. So let's take a look here. What I want to look at is the actual illustrations. Let's begin with the old product. So this is a product with a guaranteed rate of 4%, and everything is apples to apples. 4% guarantee, 40-year-old male, net death benefit, $2.8 million. That gave him the $100,000 MEC limit. Let's look at the new product with a 3% guarantee. Here's how you can tell. That's the needed death benefit, $2,050,000. But let's go back to the old one here, because here's what I want to touch on. Old one. This will be really interesting if you're looking to open a policy or if you're in the business. Where's your money going? The question I always ask is, hey, if I'm you, Mr. Consumer, and I'm looking to pay in potentially $100,000 per year, or if it's 10 grand per year, whatever, your money, going back to policy design, can be directed toward the premium piece. There we go. Or the PUA piece. So this is a company that actually allows us to go 11x the base premium technically. Wherever you set that minimum premium, they will allow you to 10x that figure, the premium figure, in PUAs for a net of $100,000. So I optimized that one as low as we legally could based on the insurance company limitations, just juiced the thing. But my point here, minimum premium, maximum cash value, old product. As we look at this guy, what do we notice? The dividend column. Here's what I want to isolate. End of year dividend. If this is the old product with a 4% guarantee, this column reflects what? It's fun stuff, isn't it? The surplus. And if I have a 4% guarantee, what's the surplus? 1.65%. So let's do this. All I want to do is take note of the dividend here. Year 2, when the first dividend is paid, and year 20. That's too low. Let's go year 15. So what do you see there? The dividend column, year 1, reads 38.86. In fact, I'm going to do this. You'll see why. Did I say year 1? I meant year 2. And then year 15, it reads what? 59.47. So let's compare that to the new one. Cash values, by the way, old product breaks even between years 3 and 4, and year 15, 772, almost 773. New product. First, let's validate the design. Are all things equal? So not in terms of the death benefit, but in terms of a minimum premium, maximum cash value allocation, minimum death benefit for that 100K MEC limit, and the answer is yes. Here's how you can tell. There's your premium. There we go. There's your PUA. Identical figures. I might be off by a penny, but that doesn't matter. Same $100,000 per year going in. I need less life insurance, so I need a lesser term rider, so the term insurance costs are a little bit less. The PUA rider fee, however, is higher with this particular company. Some companies have raised it, some have not. It's good to have awareness on that. We're going to touch on that in future videos. But as we look at this guy here, design is identical. Let's scroll down. Dividends. Here's what I want to look at. So what do we notice here? Dividend, year 2, 58.06. And what was it in the first example? 38.86. Now it's 50.86. 50.86. So it's higher. How about year 15? When the other one is 16.872. What was it in the last one? All things are equal here. Same illustration, same dividend crediting rate. Significantly higher. Why is that? Well, the guaranteed rate is what? I'm going through this slowly, but I want to be thorough here. Guaranteed rate is 3%. Total dividend interest rate is 5.65%. And this dividend column reflects what? The total surplus. So what would the surplus crediting rate here be? 1.65, like the last one in green? No. 2.65. So it's higher, and you have a lower insurance expense, which helps that dividend move at a faster pace. So the potential with this new update is really based on dividends and the non-guarantees, but it does exist. I mean, it's not just all dividend sensitive. They did reduce their insurance expenses, which should really keep the integrity of the policy intact. And the guaranteed cash values, that rate still exceeds the insurance expenses, so I walk away with more money at the end of the day, no matter what. But look at this, about 84% upfront instead of 88 to 89, breaking even between year 4 and 5, really year 5 in this example. Now year 15, what did you have in the last one? About 772? Whereas this guy, you're at 794. If we look at the guarantees though, it'll be a different story where you'll see the old product have stronger guarantees. So there's, like anything, pros and cons whenever an update occurs. But what I have noticed, specifically with the major mutuals, because that's who we work with more than anyone else, is where they are making adjustments to protect themselves as a company, at the same time, they are giving that back to the policyholders, really to maintain the fact that they're one of the major mutuals and can stay at the top, which you have to do that in this industry. But know that was a lot of information. If you enjoyed it, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.